Multifamily real estate investments, your IRA. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's AdBits, how to use your IRA to invest in multifamily real estate projects. So, podcast is going to go through and explain what a multifamily real estate project is, and then talk about some of the opportunities to use your IRA to invest, and then go through some of the tips and issues you need to consider before making such an investment. So multifamily essentially means what it means. It's basically an apartment building, a townhouse, condos, residential complexes where you have multiple units kind of grouped together. Think of, a small apartment building, right? And those are actually very, very popular investments to be done in an IRA. Why? Because they're generally very, very cash flow positive if managed properly, and they have general upside. Plus, investors feel a little bit safer investing in multifamily versus commercial real estate because the saying goes, hey, you're always going to find someone to live in your premise, especially in 2024 when there is a shortage of housing. So it's just a matter of price. In a good market, you'll be able to charge more since these rents are generally short-term, 1 year to 2 year leases. And in a down market, you may not be able to reach your maximum rent potential, but you'll always be able to get some cash flow, right? Versus commercial real estate, we all know, you have office buildings in major cities that are 30, 40, 50% vacant, which means they're underwater. So people just feel more comfortable investing their retirement accounts, IRA, 401k, or just personal funds into a multifamily real estate project. So if you're using your IRA to invest in a multifamily, well, the first question is, can you use your IRA to invest in multifamily real estate? And the answer is yes. There's only 3 things you cannot do with an IRA. Can't buy life insurance, can't buy collectibles like art, and you can't engage in any transaction that in any way, directly or indirectly, personally benefits you personally, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities controlled by such person. So if your neighbor's coming to you with a multifamily deal or a third party, then you certainly can invest it using your IRA. So now we know that, yes, you can use your IRA to buy real estate. What else you need to consider? Well, structure. There's really 3 ways that you can use your IRA to invest in real estate. You can do a full service IRA where the IRA will invest directly into the underlying real estate, probably most common. Number 2, you can do an IRA LLC where the IRA will invest in an LLC, and the LLC, which you manage, will then make the investment into the real estate. In that case, the LLC will take title to the real estate project, which is also very popular for real estate investors because of course, the protection, limited liability protection. It's more anonymity and just a little bit more freedom and control since you manage the LLC. And then recently, the self-directed IRA trust, where instead of an LLC, the IRA is the grantor and beneficiary of the trust, a grantor trust, and then you would be the trustee. You don't get the same type of limited liability protection that you would with an LLC, but you do get greater privacy since the trust is not filed with any state governing authority. So a lot more privacy. And you also have the checkbook control. So for real estate deals, it depends on what you want to do. If you're investing kind of in a one-off real estate fund, investing in multifamily, then the regular self-directed IRA works. If you're going to want more control, privacy, limited liability protection, then the LLC generally is the most popular option. So what are some things to consider if you're using your IRA to invest in a multifamily deal? Number 1, leverage. Okay, most multifamily deals that I've seen will involve leverage. What's leverage? It's borrowing money. Every good real estate investor or developer promoter knows you want to use other people's money, OPM. The more OPM, the better. Now, when rates were pretty much at 0, some of these deals got levered up super, super high, which now as interest rates have increased substantially over the last couple of years, if these promoters, developers got a little bit greedy and maybe not greedy, just little more aggressive and basically took the option of having interest rates float, they are in trouble now because the economics of that deal back in 2020, 2019, 2021 don't make sense anymore in an interest rate environment of 5% plus. The numbers don't work. The leverage was too great and the numbers worked and the economics worked based off 3% financing. Now it's 6 or 7 or 8%, and there goes the cap rate and there goes the profit. So that has caused a lot of issues in the housing market where there's been major liquidity events, great assets, where real estate funds, real estate investors basically said, hey, I need to extend, and you basically got to extend and pretend, and the bank's got to kind of let it go or take the keys back because I can't make money anymore. So that's a situation that's going to put more pressure, obviously, in the real estate market. But for those developers and promoters that got fixed interest rates, they generally have at least 5 years to pray that interest rates go back down. So there's probably another couple of years left. So obviously, when I say leverage is important. Now, if you use an IRA, number one, if you're investing in a fund, you're not going to have to personally guarantee the debt. But if you're investing in a closely held partnership, the loan using your IRA must be non-recourse. That is a loan you cannot personally guarantee, which generally is not an issue in real estate deals. But there's something called UBIT, unrelated business income tax, which a tax, if there's more than $1,000 in net profits, $1,000 allocated to the leverage, right? So if you use 80% leverage, 20% equity, 20% cash, then the UBIT would be triggered on 80% of the net profits. So if there's more than $1,000 of net profits attributable to the leverage, the UBIT tax can get triggered only in the case of an IRA or 401k or charity, not for you and me if we use personal funds. And then the UBIT tax can go as high as 37% at a very low threshold of approximately $15,000 or so. So UBIT is an ugly 4-letter word, especially for multifamily real estate deals if you're using an IRA, because there's going to be lots of leverage used and you may not be aware of it, right? You're just going to get a K1. It may not even show the amount of UBIT, right? And then the issue is, how do you report the UBIT if you're not even provided information in the books and records as to the UBIT? And that's a fair point, and that's why a lot of the UBIT goes unreported. But you may be responsible for it. You still are responsible for it, but the IRS would be on notice if it is identified in the K1 if you're doing a deal with a larger type of real estate fund who has more advanced accounting practices. So there's something to be aware of. Now, how do you get around UBIT? You can use a 401k, a solo K, and do the same deal and get around it, because there's an exception to UBIT for using leverage under Section 514C9. It doesn't apply to IRAs. It applies to 401ks. We can also limit it, reduce the 37% to 21% by setting up a C-Corp blocker. Basically, the C-Corp blocks the UBIT, and you'll just pay the 21% corporate tax rate. Those are the two common ways of doing a multifamily deal and either eliminating or reducing the impact of UBIT. You can also lend money to the deal, not be an equity investor, so you lose the upside, maybe get a 12, 15, 20% rate of return that's locked in as a lender, which may not be as attractive because the equity rights may have higher upside and maybe not. You may feel better saying, hey, if I can get a 12, 13, 15% rate of return on this deal as a lender with a higher stature in terms of repayment of liabilities on a liquidation, then hey, maybe I'm okay doing that because the cap rate may be lower anyway. So you have options. The getting into the solo K, which means you have to be self-employed, have a business with no full-time employees other than the owners or their spouses. That would be obviously the prime way of using retirement money in a multifamily real estate deal without triggering UBIT. We can also do the C-Corp blocker, which will reduce the UBIT to 21%. And then you can restructure your investment as a lender instead of an equity investor. But overall, those are the most important things to consider. It's generally UBIT. Prohibited transactions generally doesn't come up a lot. If you're doing a closely held deal with some friends and family, you got to make sure you're not going to own more than 50% of the deal personally in your IRA. If you own less than 50%, your IRA can do the deal. So just need to kind of just be aware of that. But the big thing is the UBIT. Make sure if you're using leverage, you can't personally guarantee the loan. The entity can use the assets as recourse, which means it's non-recourse, but you as the IRA investor cannot personally guarantee the loan. You can get other partners to personally guarantee it, but you cannot as the IRA investor based off 4975C. And then obviously you want to figure out a way to either eliminate or reduce the UBIT. Now, one last thing to mention, a lot of these multifamily deals, if they're private placement subscription agreements, they're going to require you to be an accredited investor, which means that you have a net worth of $1 million, excluding your primary residence, or you have annual income of $300,000 or more, married, filed jointly. That would basically allow you to get in as an accredited investor. There are some deals where you can slide in as being a non-accredited investor, but some of these deals will only have a very limited amount of space for non-accredited investors. You just need to ask the individual that's putting the deal together, if you can get in as someone who's non-accredited. And then if you are personally accredited, then obviously your IRA can invest, because your IRA can't be an accredited investor. It's all tails off you. And that's it. Those are the things to consider. They're very popular investments. Private transactions, as I mentioned, not generally a big issue. It's more the UBIT, where I spend most of my time working with clients, either eliminate it, reduce it, or do a workaround. And sometimes the deal just may not work, right? You may end up doing this with personal money versus IRA money because the UBIT ends up killing it because the C Corp blocker doesn't make mathematical sense. You may just be better off using personal funds and getting the capital gains on the sale, although the rental income will still trigger ordinary income. So it all depends on your financial needs, your goals, and kind of where you're at in the process. But that's what we do at IRA Financial. We'll help you navigate these rules, guide you through it, and help you structure the transaction to come up with the most tax efficient, tax advantageous opportunity. So it's important. That's why we don't just set up IRAs and just do all the admin and record keeping, but we're also providing you, I think, very important consulting and advisory services that really sets us apart and makes us the leader in self-directed retirement plan. So that's it for today's podcast. Hope you enjoyed it. Thanks for listening. If you're watching on YouTube, really appreciate it. Have a great day. Don't forget to leave a comment. Hopefully you enjoyed it. Leave a good review. That's always appreciative. And that's it. See everyone again next week. Ciao.